Rob's Child here with a market update. As you may have noticed, today, November 14th, 2023, the Russell 2000 went up by, I believe it's 5.44%. It's a very large move up. And I wanted to talk about it and what's going on. So, obviously, the beginning of this discussion has to start with the CPI report that came out today. And the big number, I believe, that made the Russell and all stocks really have such a bullish day is because we had a flat line of inflation. In other words, inflation has not gone up from last month to this month, or from the previous month report to this month's report. So what it kind of does is it, first of all, puts the last nail in the coffin of the idea that there'll be any rate hikes moving forward. And in fact, I haven't checked the Fed funds futures yet, but I'm assuming that the markets are going to start to price in cuts earlier now, with pretty strong conviction. Well, we might as well check those while we're on the subject. So, yes, May 2024 was sort of 50-50 on the max Fed funds futures rate being 5.5 and 5.25. It was kind of yesterday, it was kind of 50-50 on that, and now it's 60% chance that there's a cut in May of 2024. And it looks like the market's still expecting it to stay steady up until then through March, the March meeting. However, the chances of a cut have increased dramatically for the March meeting as well, from 9.6% to 32.7%. And then by June, we have, so May, there's a 50-50 chance, was a 50-50 chance that there would be a cut, and now it says 60% chance there's going to be a cut to 5.25. And then, even crazier than that is that it's expecting now sort of almost a 50-50 chance to cut again the very next month in June. And so it's the markets are pricing in cuts, and then we have 4.75 being the max rate by September is what we're pricing in. So massive expectation changes in the Fed funds futures rates, which means that bond yields have an opportunity to go down, cool off, because of largely because of reinvestment risk. It's kind of like the front end of the curve when the expectation is that the rates are going to be lower. People are going to be seeking out further and further out on the curve to have less of a reinvestment risk. And then, we saw what went on with stocks today. Now, looking at charts, it does look like the stock market's really going to take off from here, at least for a little while. But one of the other more important charts to take a look at is high yield corporate, high yield bond market. And, it got some relief, but HYT is a great fund to keep track of for high yield corporate. We gained back like 2.5 days of losses in high yield corporate bonds. And so the corporate bond buyers are seeing, it's going up a little bit because, when rates are falling for the treasuries, it has to give high yield corporate a little bit of a boost. But if anything, there's higher risk there now. When we have 0% inflation month over month, well, what's next? Negative 0.1%, and then what? -3. Just like we saw the inflation going up, and Powell said directly, we want to see it going down And then he wanted to see a pause and then accelerating further higher. If you watched the meetings back when inflation was really taking off, that was his goal, to get it up, and then we saw a dip and then further upside. That's what he wanted to see, and it happened, and then it really took off to 9%. And I think that was all on purpose to get rates to go higher so we'd have a longer runway on the eventual path to zero. But I think the path to zero is going to be paved much faster than most people think. So just like that chart, when you look at inflation, we have that dip, and moving forward, I think that we're seeing the opposite now. We saw a collapse in inflation to 3%. We flattened, and we were waiting to see, okay, the Fed paused. Is it going to tick back up, or are we going to start heading lower? So it looks like we're heading lower now. We just got that little tick downwards. And now what I'm sort of expecting is sort of an acceleration of inflation. We'll see disinflation or deflation coming up, like I'm saying, sooner than most people think. Yes, fiscal spending is high. Yes, people's wages have gone up. Yes, rent has gone up. But at the end of the day, people's, when unemployment starts going up, when people stop buying things and prices go down, that when you have that going down, and if you start seeing any kind of acceleration there, that's when we'll really get a recession. And that's kind of what I'm expecting at this point, especially in the face of the fact that, like, the timing is perfect. How I love hearing so many people on YouTube and CNBC and all these places saying how, it's going to be a soft recession or a soft landing, and there's not going to be a recession. And so inflation, I think the hope of the Fed and a lot of people was that inflation would stay sticky, because that could mean a soft landing. But if we see disinflation continue and deflation, outright deflation, kick in, then so we'll see the rates drop to zero and another wave of aggressive fiscal spending. Maybe it will be less this time because there's no COVID. There's no reason other than the economy just doing its thing, going through its natural business cycle as it should. But anyway, back to HYT. HYT sees this. The high yield corporate sees this. Dumb money is pouring into stocks, sort of rightfully so. With the rates going down, stock valuations automatically go up. But the problem is that once we get into a recession type of a thing, we usually get a stock market collapse heading into that, or even during it at some point. Some people are even saying, we already saw the crash. I don't think the crash has started yet, and I don't think it necessarily has to start for another 3 to 6 months from now. And I think we will get a crash, but as you've seen in my other videos, probably, maybe, I'm currently 60% in stocks, 40% in bonds. My stock allocation is largely commodity, largely controlled by commodities, a lot of commodity exposure, and then the bond side is zero, all zero Z, 40% in that. So what I'm expecting is, I'm expecting dumb money to be piling into stocks right now. Everybody thinking we'll probably have a little bit of a mania phase, I think, before we start really seeing the outright deflation, the disinflation, deflation affecting unemployment going higher and higher, and eventually, peaking in some kind of cataclysmic type event. I'm expecting it at this point. But for strategy-wise, I'm expecting to be able to sell. I'm thinking about selling most of my equity positions, especially I have 10% in ARK, because it's a dumb time to have ARK, but at the same time, there's a lot of dumb people. So, this could be an opportunity to sell ARK soon, before we really see the run to bonds, and then I'm all about long duration treasuries right now. That the 30-year bond yield is still at 4.6%. And if inflation is zero month over month for a year, yeah, I mean, it's like that zero, that flat number. It's I think I describe it as a pivotal moment that happened today in the release of that information. But yeah, the markets they probably won't get scared until everybody starts losing their jobs. I like maybe a year ago to 6 months ago, I was in this sort of headspace that the market knows better. Like the market can predict what's going to happen. And the market's like full of smart money that like stocks are valued at what they're valued at because like the world says so. And it's like the world knows, like, because you have, smarter people that control these things. They're not smarter people, and history has proven that over and over and over again. It's dumb money that controls them more than anything. I think dumb money has a lot more control than I used to think. And I believe dumb money is going to uh, get really, really excited about stocks for a good little while right now before we see the inflation, like I'm saying, turn into disinflation and deflation and unemployment spikes, etc. And that's when we should see a run to safety into the bond market and into the treasury market. And so, yeah, so I'm looking myself to, yeah, like I said already, cut equities, cut equities, cut equities, buy bonds, buy bonds, buy bonds throughout this period. It'll be really interesting tomorrow to see how dumb money and smart money kind of digests what's going on here tomorrow. The news day that this stuff comes out, you'll see wild, crazy things. And I mean, we might, that 5% gain in the Russell, it's possible it can go straight back down 5% tomorrow because enough people, including myself, are looking at this and saying, well, hold on, if there's no more inflation, like, it actually is a problem. It's actually, and deflation is a worse problem than inflation. That's important part of this to remember. Maybe more people know about this than I think that they do, but I don't think they do. I think dumb money is in control here in the stock market, and it's a great opportunity to be selling into this rally that should be going on for. I expect it. I expect 3 to 6 months. It's just like a random number, but yeah, that's about it. Nothing I say is investment advice. Hope you enjoyed this episode. I enjoyed making it, and see you next time. Rob Stroud.